Yes,
Yes,
the audio
everything
is
is
clear.
clear.
Okay, so let us start off with this simple revision. Let me get this done. Okay, let me check here. So, as we had discussed yesterday, they were not able to really handle the concepts. We said that the conceptual framework is a critical part of your paper, and if you are to relate it to our church life, it's more like the Bible. It provides guidance to accountants on areas that are not specifically attended to by any standard. That's what I can give, or I can say about this part of the syllabus. In fact, you realize that you are likely to use this section almost in every part of the exam. You find that you can get stuck somewhere, and you need to really apply the basics of accounting principles on a given scenario for you to earn marks. That's why the examiner goes ahead and warns us that you should expect this conceptual framework to be in every exam. As such, you should be able to give it attention, understand the key details they are in before going in for the exam. Specifically, the question that the student really wanted guidance on comes from that area of reclassification. That is part B. The directors of rational core are confused over the nature of a reclassification adjustment and understand that the International Accounting Standards Board has issued pronouncements on the subject. Of course, back then they used to set this paper under question 4. They used to examine students on what we call current issues. So SSA would get any draft paper that has been issued by the IASB and then examines students with such. Currently, now that is no longer the lane that is being taken. They always ask you on issues that are concerned with an investor. So they would ask you how maybe a disclosure or a reclassification would impact the interests of investors. That is the only difference, but the key concepts will still remain the same. The examiner continues to say, discuss with examples the nature of a reclassification adjustment and the arguments for and against allowing reclassification of items to profit or loss. A brief reference should be made in your answer to the conceptual framework for financial reporting. So that's why I uploaded this question on the LMS, and I wanted you to at least have an experience of how question 4 can appear in the lens of a conceptual framework line. So before approaching this question, probably we can first run through what really comes under this conceptual framework. And basically, we should know that since it is more like the Bible of financial reporting, it therefore contains key principles that can be used by the standard board, the IASB, to develop new accounting standards. It can also help us, the preparers of financial statements, to interpret some situations where there is no specific accounting standard that applies. As such, we are expected to really understand what this framework specifically lists out. So, for you to be able to use this conceptual framework in situations where there is no specific accounting standard that applies, you should be able to tell, one, the key characteristics of financial statements. That is the qualitative characteristics. We know we have the basic or the fundamental. Someone wants to join. Yes, I said for you to be able to apply the conceptual framework where there is no accounting standard that applies, you should be able to know the basic components of the conceptual framework. That one includes the key characteristics of financial statements. That is the enhancing characteristics and the fundamental characteristics. Okay, so we can look at the qualitative characteristics. This is the first component of the conceptual framework that we should be able to know. And I've said there are two. We have the fundamental characteristics and the enhancing characteristics. So if I am to ask, who can give us any of the fundamental characteristics known to them? Do we know them? I'm just doing high level review of the conceptual framework, and I'm picking out key concepts that you should know before you go for the exam. When it comes to the conceptual framework, it guides us on this, but for us to be able to understand how to apply it when there's no accounting standard, we should know the key characteristics first. I'll call it number one. So who can tell me any one fundamental characteristic of a financial statement? You can unmute and speak out. Daniel, do you know any?
Hi, Ivan.
Hello, yes, Sheila. Yes. Rachel, do you know any?
Fair representation.
Fair representation, or we can call it faithful representation. Perfect. Faithful representation. And what is the key defining concept under faithful representation? What is it all about?
The, the financial statements should be free from
Oh,
errors
okay.
and any fraudulent.
And any fraudulent? Have we lost you?
Any fraudulence.
Okay,
Any
perfect.
fraudulence.
Perfect. So we are saying that the financial statements should be faithfully represented. That is, you only include a transaction in the financial statements based on its economic substance, and therefore the financial statement should be complete, should be neutral, and should be free from any error. I remember I had summarized these things in my notes because this is key. When you're explaining the exam, you should talk about full representation of all the transactions based on their economic substance and not the legal form. And therefore, we expect the financial statements to be complete, to be neutral, and to be free from any error. That is key. So in your summary, you can just put, you can say transactions based on economic substance, on economic substance rather than rather than legal form. As such, should be complete. As such, should be complete, neutral, neutral, and free from any errors. So, once you read a transaction in a scenario where you feel maybe you cannot remember a given standard that applies to it, or there is no standard that applies to it, even in your normal working environment, you can go ahead and check if such financial statements or if inclusion of such a transaction would make the financial statements free from errors, would make them complete, not leaving out any transaction, and should be true, should be neutral in sense that it does not create biasness to those who are going to read them. Okay, perfect. So that is the first one. What is the second fundamental characteristic? Anyone?
Materiality.
That is not a characteristic, though it is very important. Shall look at it.
Relevance.
Yes, relevancy. What does it mean?
The financial statements should hold information that is critical to decision making by the users the of the information in those financial statements.
Perfect. Something is relevant to you if it can influence your decision. I don't know if you're getting it. So what does it mean? We should always look at materiality of the information we are including in the financial statements. So when it comes to relevancy, we are looking at such transactions or such information that can have an influence on the decisions of the users of the financial statements. Okay? Information is relevant if it can influence the decisions of the users of the financial statements of the financial statements. And of course, I believe you all know the users, the key primary users of financial statements. Do we know them?
Yes.
Who are those ones?
Potential investors,
So you can say,
Current investors,
okay. So you can say investors, those are potential and current, okay.
banks,
So any provider of funds, you can call them lenders. Who else? And creditors.
mm,
Basically, these are the key primary users of financial statements. We always look at those guys who give us money, who give entities money. So those are the investors, lenders, and creditors. These are known as the key users of financial statements. But now the governments, we can have regulators. Those are just other users of financial statements. This is information that should be on the fingertips. Okay, so qualitative characteristics. The first one is fundamental characteristics, which include faithful representation and then relevancy. So here we're saying only material information, only material information should be included in financial statements. And now this is important. We should know what material information is. In fact, information is material if, when it is omitted, when it is misstated or obscured, could influence the economic decisions of the user. They are key terms that we use. Information is material if, when omitted. I can write it here. Okay. Information is material if, when omitted or misstated or obscured, could influence the economic decisions of the users. And who are the users? Financials. Who are the financials? Investors, lenders, creditors. Basically, those are the key users. So these are critical statements that you should look out for when it comes to the key or to the fundamental characteristics. Now, after the fundamental characteristics, we have what we call the enhancing characteristics. So, who can tell us any enhancing characteristic known?
Understandability.
Yes, understandability. Those are not understandability. Then what else?
Comparability.
Comparability. Comparability. What else?
Verifiability.
Verifiability. Then any other? Timeliness, right? I will not explain these ones because, of course, we've had this in class, in normal class, and even information is available. However, make sure that at least you know all these characteristics before going for the exam. How does it help you? How does it help you? You can be able to interpret situations in the scenarios given to you, or even in the life working environment where no specific accounting standard exists for you to apply to that specific transaction. Because you'll be tasked to give this. And if you can remember, those who have already covered ethics, I tell you or I show you how you can use the conceptual framework to earn your first mark in ethics by saying accountants and preparers of financial statements have an obligation to provide faithful and relevant information to the users of financial statements. As such, financial statements should be complete, neutral, and free from errors, while only presenting material information in such financial statements. That is the free mark you'll ever earn under ethics. Before even looking at all other points, make sure that you show the examiner that all errors that I'm going to find in this ethical question is a responsibility of the accountant. And this responsibility is given by the IESB or SCCA Code of Ethics, as well as the conceptual framework. Daniel, am I speaking?
Yes, I'm getting you.
Yeah, you can
So
use it.
I'd gone off.
So you can use these for you to earn a free mark in the ethics question by making just that open statement and giving the examiner an impression that this accountant, whom I'm going to read about in the ethics scenario, has a responsibility of protecting the interests of the primary users of the financial statements. Okay, so second part that we should always know from the conceptual framework are the key elements. But we said this is the Bible. It has given us the principles or the characteristics of good financial statements. Now it is giving us what these financial statements should contain. Okay? One, it gives us what assets are, it gives us what liabilities are. It also goes ahead to explain to us what equity is, as well as now incomes and expenses. Yes. Yes, Daniel.
Yes, kindly recap the statement on ethics. I'd gone off. My network is not clear.
Yes, I've said you can earn a free mark in ethics by just making an opening statement. You can say accountants and preparers of financial statements have an obligation to present faithful and relevant information to the users of financial statements. Now you can even put those users, you can put creditors, lenders, and investors. Financial statements should be neutral and free from any errors, while only those that are material, okay, so while only material information which can influence the decisions of a user when omitted, misstated, or obscured should be presented in these financial statements. So you're trying to show that indeed all the errors that I'm going to read from this scenario are a mandate or are a responsibility of the accountant because they are expected to provide faithful and relevant information within these financial statements. Then have you got it?
Yes, thank you.
You can even go ahead and say, as per the IESB Code of Ethics, accountants should protect the interests of the users of these financial statements. And if I had even, for me, I had even put down all my opening statements. You can say, preparers or management is a steward to the interests of the financial, to the interests of the users of financial statements. Therefore, they should be able to present. Then you add this. And it is true. Management and accountants and financial statement preparers are just stewards. The principal is the owner of the business. Therefore, you have an obligation to present financial statements that are in this, that qualify all these characteristics. And trust me, that is a free mark for you. Okay, so the second part is the elements: assets, liabilities, equity, income, and expenses. And trust me, when presenting financial statements, in the statement of financial position, we shall find these. So before you include any item in the statement of financial position, it should be able to pass the definitions as given by the conceptual framework. And when preparing the statement of profit or loss that contains the income and expenses, those items that we're going to include in that statement of profit or loss should be able to pass the definitions provided by the conceptual framework. Okay, so the conceptual framework defines an asset as a present economic resource, a present economic resource controlled by an entity as a result of a past event. I remember during our days when we were sitting SBR, that is the time when bitcoins were can I call it were a thing of the day. So we would be tasked to evaluate how cryptocurrency can be included in financial statements. Is it an asset? Is it a liability? So we would use this definition. You start by evaluating if it indeed is an economic resource that an entity has control over. This statement is very important. One, is it a present economic resource? Two, is it controlled by the entity? Then three, is that as a result of the actions that you did in the past? If the transaction does not pass those three, it shouldn't be part of your assets that you present in the statement of financial position. What is important is for us to know what is an economic resource. Very important statement. And the conceptual framework, the Bible says an economic resource is that right that can give an economic benefit. Good. An economic resource is any right that can give or we can say that can give or has the ability to give an economic benefit. And when I'm teaching, I always talk about these economic benefits. This can be in form of cash. It can be in form of economies of scale. It can be in form of saving an entity from spending. That is an economic benefit. You can either receive cash as economic benefit. You can either benefit from economies of scale, that is large scale productions, or you can save the entity from spending. So an asset is that economic resource or is that right that gives an entity or that has an ability to give an entity an economic benefit, and such is controlled by the entity but coming from the performance of certain events in the past. Daniel, does that make sense to you? Daniel is off. Nasali, does that make sense to you?
Yes.
Okay. Then it comes to any question before I move on. Please, you can ask any question. Okay, perfect. Liabilities. While an asset is an economic resource, a liability is a present obligation. a present obligation of the entity to transfer an economic resource as a result of a past event. Anything that involves taking out any economic resource, and we said an economic resource is this. So if you are likely to pay out money, which is cash, it is going out of the business, or you are likely to forfeit an opportunity to enjoy economic benefits, that becomes a liability. And it's only at that point that you should include such a transaction as a liability. When it comes to IAS 37, we talk about provisions. And a provision is a liability of uncertain timing or amount. That's why we always tell you that under IAS 37, you cannot provide for future losses. Why? Because future losses are not as a result of past events. Yes, they are likely to be a point of losing economic resources, but these are futuristic in nature, so they don't qualify to be a liability. As such, you cannot make a provision for them. But we are getting all this guidance right from the conceptual framework that defines a liability as such an obligation that is going to transfer an economic resource out of the entity as a result of a past event. Anything that involves futuristic events then cannot qualify to be a liability. When it comes to equity, the residual interest, in the assets, in the net assets of the entity. I always tell you that from the basic accounting equation, where we say that assets equals, is it equity plus liability. So from this accounting equation, once you rearrange this equity, it becomes assets minus liability. Okay, and that becomes the net assets of the entity. While incomes, before let me discuss income, anything that increases assets, increases in assets, or decreases in liabilities. Okay, of course this will result into an increase in equity. That results into an increase in equity. Once you have an increase, okay, I can rearrange equity equals assets minus liability. So if assets increase, then equity is increasing from basic math. If liabilities decrease, then equity is increasing. So anything that comes into the entity as an increase in assets or decrease in liabilities, it's an income in nature. That's why you find that we always include interest, we always include revenue, because revenue is an asset in form of cash. Interest is also revenue in nature for such businesses that always invest maybe in debt instruments and they have income or interest coming through in form of cash to their banks. So anything that really comes into the business and it is aiming at increasing the assets or decreasing the liabilities of the entity forms part of the income of the entity. But you're going to ask me, what if the owners of this business make a contribution in form of cash to their business? Is that an income? Who can answer that question? Can we call that an income? Daniel, is that income?
Beg your pardon?
Assuming that owner of a business injects capital in form of cash into the business, can you call that cash an income?
I think we cannot call it income.
Perfect. Not any contributions. Any contributions from owners you can call them equity holders, is not an income. So you cannot say when you're presenting your statement of profit or loss that the owner of the business injected 1 million USD and then you record it as income from business. That will never be. So if you will find by the such situations, these things, we just define them here, not until when you find a scenario where the accountant is recognizing owner contributions as income in profit or loss. Then you ask yourself, which standard is this? Is it IFRS 15? Which one is it now? Just go back to the requirements of conceptual framework. It tells you any owner contributions is not income. So build your answer from this statement and then you advise them to remove that contribution from incomes and take it under owner equity.